Over the past few weeks, we have seen many dividend stocks announce that they are increasing the amount they pay out in dividends. And if you know anything about dividend stocks, you know that dividend increases can really play a major role in causing the dividend snowball effect to take place. For example, my expected yearly dividend income has climbed by hundreds of dollars over the past few months simply from my holdings announcing that they are increasing their dividend payouts. So in this video, we're going to be looking at 13 different dividend stocks that just announced dividend increases. To analyze these stocks, we'll be using my automated spreadsheets from tickerdata.com and the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. Link in the description to check it out. Now let's jump in. The first company that just announced a dividend increase is actually one that I own in my personal portfolio, and that is Caterpillar. They just increased their dividend by about 8.5%, but it's also worth mentioning, this company just increased the size of its share repurchase program as well. If we scroll down, we can see Caterpillar is expected to repurchase up to $21.8 billion worth of shares. Now, I'm actually a huge fan of share buybacks when they're done the right way, and we'll talk about that just a little bit later. But if we keep moving forward, we can see Caterpillar is currently trading at about $329.08 per share, and over the past year, they've actually done really well, up by about 33%. And if we jump over to my dividend breakdown sheet, again, we'll come over here, plug in CAT, and hit enter. And this data will automatically load in thanks to Ticker Data. Now, the starting dividend yield for this company, we can see, is currently sitting at 1.71%. But if we jump over to my personal portfolio, blow up my dividend yield on cost chart, if we look at my Caterpillar position, we can see my yield on cost is actually sitting at about 3.13%. Now, why is this? Well, first off, if we jump over to Caterpillar, let's go ahead and look at the dividend yield history for this company on Seeking Alpha. If we scroll down here and look at the past 5 years, we can see for the most part, this company hasn't had anywhere near a dividend yield of 3% except for 2020 when pretty much all the stock's share price was dropping pretty dramatically. And I actually added this company to my portfolio in October of 2022. Now, what we can see during this time, the starting dividend yield was sitting at about 2.5 to 2.7%. So because I was able to buy in at a much better valuation, I got a better starting dividend yield. But I still have a dividend yield on cost of over 3%, and this is because the company is constantly increasing their dividend payouts, giving me a higher yield on cost. If we jump back over to my dividend breakdown, we can see the dividend history for this company actually looks pretty good. The 5-year dividend CAGR sitting at about 8.33 and the 10-year sitting at about 8%. We can see free cash flow has really taken off over the past 5 years, and if we look at the free cash flow history, it's easily covering those dividend payments, and in fact, the free cash flow payout ratio as of right now, sitting at about 26%. Now, if we jump over to the stock screener, come up here, plug in CAT and hit enter, and the data will load in. Now we can see revenue per share has actually climbed quite a bit over the past 4 years. Look at 2020, sitting about 76, 2023 all the way up to 131 per share. We can see earnings per share jumped up quite a bit over the past few years, and the same is true with free cash flow per share. And like I mentioned earlier, shares outstanding has been declining. They are buying back shares. Now again, share buybacks can be a really good way to reward shareholders when done the right way. They need to be bought at the right valuation. And when a company buys back shares, it automatically boosts all of the per share metrics like earnings per share, revenue per share, free cash flow per share, and can even help the dividends paid out per share. Now if we quickly jump over to the profitability and income statement, one thing that I want to point out is gross profit ratio. This has really taken a big jump up over the past decade for this company. We can see the 10-year average sitting at about 29%, but in 2023, their gross profit ratio was all the way up to 35%. So lately, there has been a lot going right for this company, and it's the reason I'm up so much on this position. If we quickly jump over to my investment dashboard and blow up my growth chart, you can see this is actually one of my biggest winners, currently up about 87 to 88% on this position. The next stock that just increased its dividend is Target, and they had what I would call the dreaded below inflation rate dividend hike. Their dividend increase was around 2%, and we have to keep in mind, anytime a stock increases their dividend payout below the rate of inflation, it means they're technically paying out less in dividends, so this is not a good thing to see. Now, if we jump over to Seeking Alpha, we can see over the past year, they are up by about 8%. If we jump over to the dividend breakdown, come up here, plug in TGT, and yes, that most recent dividend hike was around 2%, pretty bad honestly, but we can see the 5-year dividend CAGR is still pretty good, sitting at about 11.5%, and over the past decade, closer to about 9%. So historically speaking, the dividend increases have actually been pretty good. But what we can see is free cash flow has dramatically drawn back over the past few years. 2020 was a great year for this company. Record free cash flow sitting at about $7.87 billion. Slight decline in 2021, but still significantly higher than where it was before 2020. But then 2022 hit, and it was a pretty horrendous year. Negative free cash flow. And then 2023, we're kind of getting back on the right track, sitting at about $3.8 billion in free cash flow. And that free cash flow is covering that dividend payment. They have a free cash flow payout ratio of about 52.71%. And as of right now, starting dividend yield sitting at about 3%. Now, if we quickly glance at the stock screener, you can see I've already plugged in TGT. I do want to point out, this is a company that has bought back a pretty good amount of shares over the past decade, going from about 656 million to in 2023 all the way down to around 462 million. Definitely worth noting. The third stock that we're looking at that just announced a dividend increase is Williams-Sonoma, and this one wasn't too pretty, but I will say the share price appreciation has been really good over the past year. We can see this was around a 1% dividend increase, so a very small dividend increase. But if we look at the company over the past year, they're up nearly 118%, and if we look at them in the past 6 months, up around 39%, and in the past month alone, they're actually down quite a bit, down by about 6.62%. Now, something I definitely have to point out about the company, the short interest is pretty large. It's sitting at about 9%, so there is a lot of people betting against this stock. A little bit scary to think about, but if we jump over to the dividend breakdown sheet, we'll come up here, plug in WSM and hit enter. The data will load in, and we can see the starting dividend yield sitting at about 1.65% and very low payout ratios, leaving a lot of room for dividend growth in the future, even though they elected not to grow the dividend that much this most recent dividend hike. And if we look at the past 5 years, the dividend growth has been close to almost 20%. So yes, again, the most recent dividend increase was pretty small, but the 5-year history is pretty impressive, and the 10-year dividend CAGR follows along with it, sitting at about 13.37%. Now, why are they able to increase their dividend payouts at such a high rate? Well, it's pretty obvious when we look at the free cash flow growth. Free cash flow has exploded, especially since 2020 and 2023, a record year for the company, close to $1.5 billion in free cash flow. And the result of them growing free cash flow this much is we can see that free cash flow payout ratio declined by quite a bit over the last few years. Before 2020, we can see this company typically had a free cash flow payout ratio sitting close to around 35 to even 50% in 2014. But we can see in 2020 that free cash flow payout ratio got all the way down to 14.26%, and in 2023, like we just mentioned, it's all the way down to about 15.58%. So we're talking about a company generating a lot of free cash flow and easily covering those dividend payments, and the end result, again, massive dividend growth. Now, I do want to quickly mention Williams-Sonoma did also recently announce a 2-for-1 stock split, so keep in mind, on an adjusted basis, they did still increase their dividend payments. The reason I quickly wanted to mention that is I actually saw an article on Yahoo Finance by Simply Wall Street with just completely incorrect reporting saying that they're receiving a smaller dividend, just not true, and it's saying that the company's dividend is being reduced. This is why it's important to do your due diligence, because this is simply not true. Our fourth stock that just announced a dividend increase is Darden Restaurants, and they just raised their dividend by about 6.9%. Now, if you aren't familiar with Darden, this company holds different restaurants. For example, you may see some names here that you know. We have Longhorn Steakhouse, Olive Garden, Ruth Chris's Steakhouse. And if we look at the company over the past year, they're actually down by about 11.42%. And if we zoom out, look at them in the past decade, it's actually been pretty good, up by about 272%. Now, I will note, this is another company with a little bit more short interest than I typically like to see out of stocks that I want to hold in my portfolio. But if we go ahead and jump over to my dividend breakdown sheet, we'll come up here, plug in DRI and hit enter. And we can see this company has a decent starting dividend yield. It's sitting at about 3.78%. And the dividend growth has actually been really good past decade, around 11%, past 5 years, close to about 11.5%. But one thing we do need to take note of, we can see in 2020, they did reduce their dividend pretty significantly, which is pretty common for a lot of companies. So not necessarily the end of the world, because the dividend growth over the past decade has actually been really good, but that is definitely something to take note of. Ideally, I would prefer to see no dividend cuts from any of the companies that I hold in my portfolio. If we look at the payout ratios, we can see FCF payout ratio sitting at about 62% and payout ratio as a result of earnings sitting at about 60%. So we can see for the most part, free cash flow easily covers those dividend payments other than 2020. 2021 free cash flow sitting at about 925 million, 2022 857, and in 2023 951. And over the past 10 years, they have a free cash flow CAGR of about 13.7%. Our fifth company that just announced a dividend increase is General Mills, and again, this is another small dividend hike, nothing to be excited about. Sitting at about 1.7%, clearly below the rate of inflation, which is definitely not something I like out of the holdings in my portfolio, but I don't actually hold this one in my portfolio. But if we look at them on Seeking Alpha, past year has been pretty rough. While the S&P 500 has been on a tear, they're actually down by about 18%. And if we look at them year to date, pretty flat, but down slightly, especially in the past month, down by about 2.89%. The past month been pretty bad, down by about 8.38%. We jump over to the dividend breakdown sheet. We'll come up here, plug in GIS, and hit enter. And we can see this company has a good starting dividend yield sitting at about 3.79%, and the payout ratios seem to be in a decent range for the most part. Now, the dividend growth really hasn't been that high over the past decade. We can see a 10-year dividend CAGR of about 4% and a 5-year of about 4%. So again, yes, those dividend payments are increasing, but it's been pretty slow overall. And meanwhile, free cash flow has actually been pretty stagnant as well. So the end result of stagnant free cash flow and even slow dividend growth is we're going to see growth in the free cash flow payout ratio over time, which is definitely not something that I want to see. For example, we can see 2020 free cash flow payout ratio was as low as 37%, but since then it has continued to climb up again, now sitting at about 61.65%. Those aren't really things that I like to see. Our sixth company just announced a double-digit dividend hike, and that is Kroger. They announced a 10.3% increase to their dividend payments. That's a pretty decent dividend hike. We love those double-digit dividend hikes. We can see over the past year up by about 6.58%, and if we really zoom out, look at the past 10 years, they've actually underperformed the market. They're up by about 101%, not including those dividend payments. Now, if we jump over to the dividend breakdown tab, come up here, plug in KR and hit enter, we can see this company has a starting yield sitting at about 2.53%. And this may surprise you, but the dividend growth has been phenomenal from this company over the past decade, sitting at 14%. Over the past 5 years, 16.36%. Look how much those dividend payments have grown over the past decade. It's gone from about 31 cents all the way up to $1.10 in 2023, and now we're sitting at $1.28. So really good dividend growth from this company, and the reason behind this, like always, for high levels of dividend growth to be sustainable, we need to see high levels of free cash flow growth, and they have definitely seen that, especially since 2020. And as of right now, we can see very healthy payout ratios. FCF payout ratio at 26.78, and the payout ratio as a result of earnings sitting at about 30%. And if we jump over to the stock screener tab, come up here, plug in KR and hit enter. A couple things we should notice. First off, revenue per share has very consistently grown over the past decade. Now, it's not necessarily been growth at a super high rate, but we do like seeing year-over-year growth from pretty much any company that we're looking at. We can see earnings has grown, free cash flow has grown, but the big takeaway here is they have bought back a lot of shares over the past decade, which of course boosts things like earnings per share, revenue per share, and free cash flow per share. And in fact, they've actually bought back over 25% of their shares over the past decade, going from a little over 1 billion 2023 all the way down to around 718 million. And if we look at the profitability and income statement, something I want to point out, revenue growth has been organic as well. It's not just from buying back shares. Of course, sometimes revenue per share can still grow even if revenue is stagnant if you're buying back a lot of shares, but again, they are seeing organic revenue growth as well as revenue per share growth. Now, for the last 7 stocks that we're going to look at, I just want to briefly touch on them, and I want to make it clear these are all stocks that operate in the financial sector. And the first one we can see is Jefferies Financial Group, and they had a massive dividend increase of about 16.7%, and this is a company that I own in my personal portfolio. If we jump over to my do-it-yourself investor toolkit and blow up my growth chart, this is a huge winner in my portfolio. I'm currently up a little over 65% on this position, and if we look at my dividend dashboard again, what you'll see is my dividend yield on cost for this company now sitting at 4.5% because I bought at a great valuation, and obviously they're rapidly increasing their dividend payouts. Now, the next company we can see is Morgan Stanley. They had a pretty good dividend hike of about 8.8%, and they renewed their $20 billion share buyback program. Then we can see Bank of America. This is another company that I own in my portfolio, so I was very excited to see a very nice dividend hike, coming in at about 8%. The next company is Citigroup. We can see a decent dividend hike, sitting at about 5.7%. And then we have Goldman Sachs. They boosted their dividend by about 9%, so a really nice dividend increase from Goldman Sachs. And then we have, finally, US Bancorp. They plan to increase their dividend by a measly 2%, so a pretty small dividend hike coming from them. But keep in mind, this is a bank with a pretty high starting dividend yield, sitting close to about 5%. So there you go, those are 13 different dividend stocks that just recently announced increases to their dividend payments. Go ahead and let me know what you think in the comments down below. If you'd like to be able to download any of the spreadsheets you saw in this video and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.